This next answer is for the question, what are the risks of owning triple net leased investments? That's a really great question because the risks sometimes scare people out of buying triple net leased investments or any other commercial property for that matter. One of the reasons that investors like these, like I mentioned before, that they're like bonds or owning a corporate bond, is the fact that the risks are inherently lower when you're dealing with a tenant who's behind the lease, who is actually a national credit tenant. When you have a national credit tenant, you have the strength and the ability of a multi-billion-dollar case company in some cases, not just a local mom and pop tenant, but a very strong tenant to pay the rent. But again, there are always risks with any investment. Some of the common risks are, of course, when the tenant decides they're not going to renew the lease, or let's say the tenant can't continue with the lease. That's one of the biggest single risks. The risk is to the cash flow and losing the income. For some people, when you pay all cash for a property, they're not so worried about a lost income as they are, how are they going to make the mortgage payment? When you have a mortgage on a property, that mortgage has to be paid. If you were to set aside funds to offset those mortgage payments in the event of a default or in the event the tenant doesn't continue to pay the rent or defaults on the rent, then you have funds to offset that risk. But there's also kinds of risk like population density. Imagine you open up a Starbucks in a downtown area of San Francisco and you've got the population that you have in San Francisco versus downtown, let's say Modesto. For example, in California, those two populations are quite a bit different. So the dynamics to risk come in when that property could go vacant and no tenant could replace it, at least for a significant period of time. It's really about the vacancy is what we're talking about. There are other risks like interest rate risk. Imagine owning a property for 10 years, you need to refinance the property now, and the interest rates have gone sky high. We've seen that happen in the past, and you can't refinance the property, or the loan to value you started with is no longer the same because the value of the property has come down, and now you find yourself close to being upside down on a property. So there's market risk, there's interest rate risk, there's tenant risk, there's location risk, there's even government risk. The government has threatened to do away with the 1031 exchange, for example. So all of these kinds of risks are inherent in just about every kind of commercial property, but in triple net leased investments, some of these risks can easily be eliminated and for the most part are alleviated and make it a much more attractive property than, say, a vacant piece of land or parking garage. Anyway, thanks for the question.